There's been a lot of M&A in the battery metal space. One of those deal makers is Jervois Global. The CFO is James May. James, welcome to Kitco.
Thanks, Michael. Great to be here.
Can you describe what Jervois Global is? You have mines, but you also have refineries, James.
Yeah, that's right. Thanks, Michael. So Jervois as a company has been around for a few decades on the ASX, but went through a major reset in 2017 with the installation of a new management team, a new board, and fundamentally new direction. Really at that point, with the introduction of Bryce Crocker, our current chief executive, he was a founding member of the Xstrata team that grew that business in London very successfully through the early part of the decade. Peter Johnston, who was formerly the chairman of the global nickel business for Glencore, really enacted a wholesale reset focused on cobalt and nickel and assembling a management team that's got deep capability and experience in the sector. So really since then, we've grown through a series of acquisitions, started with a really progressing studies on a greenfield asset in Australia called Nikko Young, a nickel laterite deposit. Did that through 2017 and 18. And from there, really created a tailwind for the company that opened the door in M&A. And since then, we've grown and assembled a portfolio of near-term cobalt assets with nickel exposure as well. We've got a project that's underway in the advanced stage of construction in Idaho. It's a cobalt mine, a primary cobalt mine that will represent really America's only source of primary cobalt that it's had for many decades, and really sort of strategically significant as we bring that into production later this year. We also announced an acquisition structure over the SMP refinery in Brazil, which is a nickel cobalt refinery that ran successfully between 1981 and 2016, subsequently mothballed for strategic reasons by its former owners. And really, we saw that as an attractive way to step in very cost effectively and look at restarting that refinery. And we've just announced an FS around that restart pathway. And then last year, we executed an acquisition. We bought the residual cobalt processing business in Finland that Freeport McMoran owned, the business in Kokkola, which really comprises of a number of different facets. The key business has an input ingredient, which is cobalt hydroxide, an unrefined cobalt form, and we take that through two transformation stages to produce a range of specialty products in cobalt, both for traditional industrial uses and for the battery end segment. And look, from my perspective as CFO, it's been great having that business. It gives us an operating business today that's we've guided the market is going to generate between 50 to 55 million US in EBITDA this year. So a good near-term cash generating asset. And then you put that together with the two assets I just described around genuine near-term development opportunities in the Americas, and you can kind of see we're assembling a portfolio of near-term assets to create a platform in nickel and cobalt that offers really a diversification away from China supply for Western world OEMs and other industrial players.
James, why go downstream? I just compare when you're talking to, say, for instance, like the precious metals miners. I've noticed you're not the only person. I think of other companies like Sibanye Stillwater and other people in the battery metal space that seem to be going to the refineries.
Yeah, look, it's a good question, Michael. And, sometimes we get compared to iron ore and steel and very, very distinct and separate and unintegrated in the 21st century approach to that industry. But we fundamentally see battery materials as different. There's real genuine opportunity to capture full margin through the value chain, offer an end-to-end integrated solution to customers, demonstrating full traceability of our products through the systems. And moreover, from my perspective, what I really like is that it gives us some opportunity to manage risk. And what I mean by that is by having diversification up and down the value chain, what we expect to see in these very high demand growth environments for products like cobalt or nickel in the decade ahead is that the bottlenecks in those systems are going to move around. Sometimes it'll be in mining, sometimes it'll be in refining, sometimes it might be further downstream. And we see constraints of bottlenecks in multiple segments. And by having multiple ways to play the value chain, it gives us both an opportunity to harvest strong cash flows when those bottlenecks and moments of dislocation occur, and also manage risk because we've got that diversification. Now, it's not to say we're going to participate in every segment, The battery value chain is quite long. It sort of starts in mining and ends up in cathode active materials and battery manufacturing. But we do think we've got distinct strengths, particularly in mining, as we're demonstrating in our delivery of ICO in Idaho, and also in refining, where between the team that we acquired in Finland and our corporate team through Michael Rodriguez and some of the other experts we have, we've got some of the leading brains in nickel and cobalt processing that exist globally, and we really think we can really exploit the strengths we have in those segments as we go forward.
What's the status of the Idaho cobalt operation, James? What's the next steps?
Look, it's really exciting. I was just there a week or two ago. It's in an advanced stage of construction. If I go back to sort of contextualize the project, there's been efforts to construct a cobalt mine in Idaho using in the location where we are for a couple of decades, and reality is, like a lot of mining projects, somewhat sort of stopped and started throughout the years. Now, when we took that on in 2019 through an acquisition of a Canadian company called eCobalt, we went through a big reset. We updated the feasibility study. We set our sights on executing a project plan that would see us get into production quickly with a low capital, high IRR start. And over 12 months ago, we assembled the final funding package, which was approximately 135 million US. 100 million came from a bond, a debt instrument that we issued in July last year. The balance came from an equity raise that was part of the same equity raise we did for the acquisition in Finland. And so really since then, we've set about delivering that final construction stretch. And, what that actually looks like is we're quite a good way into developing the underground mine, getting right up close to the ore body, and working through the readiness activities to actually start mining in a few months. And concurrently with that, constructing the surface infrastructure for the processing steps that will occur on site, as well as completing the remaining operational readiness activities that are required to bring that product out of the ground and through the process and ultimately to market as well. So look, when you take a step back, I mean, we're on track. We're delivering a relatively modest capital budget of 99 million US, which in the wider scheme of things for mining is very manageable. We're right at the pointy end of that. We're looking at first commercial production in Q4, with first ore through the mill probably around September, and then ramping up through that latter period in the year. So look, I think we're in pretty good shape, Michael, and we'll continue to monitor that closely as we get closer to those production steps.
You've done a lot of deals, as you just mentioned. You have the financing that you've done for Idaho. Then you've also had the acquisition in Brazil, and then also what you did in Europe. What's the mood of the markets now, James, with this drop? Is it going to be more of a digestion phase?
Yeah, no, it's a good question. Look, I think what's sort of interesting about the backdrop we have is that when you see these sort of volatile times, generally the companies that come through the best are the companies that are the most prepared and the ones that are the strongest. And so what we've done to ensure that we are resilient to all stages of the economic cycle as we go forward is that we've been focusing, as I indicated earlier, on near-term assets. So we're not talking about big assets with hundreds of millions of dollars and long runways. We've got a cash-generating asset today. We're looking to bring on 2 more in the next couple of years. We don't have huge capital needs, and that actually favours us as we sort of look about this sort of rotation that we're seeing in the market from, as some would say, from growth companies to sort of value stocks, and we think we've got a degree of resilience in that context. And look, I think the other thing I'd add is that what I've been amazed about is that notwithstanding the volatility that we've seen in the equity markets, that the market, particularly here in Australia, and I think it's the same globally, has continued to show a pretty strong degree of support for the right type of battery materials companies. And I think there's enough sophistication in the market that notwithstanding that volatility and the adverse impacts it can have on all companies, that there is a group of believers that we are at the beginning of a long-term secular trend that will sort of transition through a number of sort of shorter-term bumps as we go along in the next 5 to 10 years.
Just a point that you made, you're talking about 2 other operations coming online for generating cash. I guess that would be the Brazil operation as you kind of work through it, as well as ICO?
That's correct. So with SMP, we the acquisition structure we announced in 2020 was intentionally designed to look at a de-risk pathway to restarting production. So the terms of that acquisition, we have the opportunity to do the feasibility study before closing the acquisition. We've now done that feasibility study. We've reported that to the market. What we announced was a stage one restart of the refinery that would contemplate restarting on the basis of 2,000 tonnes of cobalt capacity, 10,000 tonnes of nickel capacity, and that cobalt capacity is matched to the output of the ICO. So the important way that our business model is designed to function is that is recognising ICO has an intermediate product through a cobalt concentrate, is then to have SMP available as an outlet to then process that or that intermediate product, I should say, into a refined form through that circuit. And then you put that together with the nickel capacity that's always existed in the history of the operation. It used to, in its day, process around 25,000 tonnes of nickel when it was sort of co-owned alongside a nickel mine by its former owners that's now depleted. So what we're looking to do is do a sort of a staged restart where we can buy nickel units through MHP and turn that into refined nickel. When you put all the pieces together, what we're looking at for that stage one restart, subject to closing the acquisition, which we expect to occur shortly, it's a $55 million US capex requirement, and that really is a 12-month runway to restart. And the EBITDA under the assumptions we published in our FS are between 30 and 35 million US a year on that basis as well. So again, we're not targeting something that's massive scale on day one. We're targeting a de-risked, low capital pathway, really demonstrate that we can restart the asset, get it into production, and then, if we're successful in doing that, that will open the door on a further expansion stage thereafter.
Let's talk a little bit of macro in the battery metal space, James. Lithium-ion phosphate batteries seem to be gaining more traction with the automakers. They're looking at that battery because it kind of eases off on some of the high prices for battery metals right now. Is that a potential threat to cobalt suppliers, James?
Yeah, thanks, Michael. Look, it's interesting. I think we're in a very fast-moving industry in terms of battery technology and demand, and I'm certainly of a belief that there's room for both and multiple types of battery technologies, cathode chemistries. LFP will very much have a role in certain end uses where EV range and performance is less of a consideration, and charging can happen on a relatively frequent basis. So, if you think about delivery vehicles in suburban cities, for example, could be very well suited to an LFP style of battery. We do, however, continue to have a genuine belief that when you look at the acceleration of adoption in Western markets, particularly Europe, and what we'll see ahead of us in the US, range and performance really matter. And to get that range and performance, that LFP, despite the improvements in that technology, are going to be less favorable than deploying nickel-rich chemistries and NCM chemistries into batteries to really drive that range and performance that we think that consumers will be looking for. So very much when we look at forecasts and look at most sort of what we would see as credible third-party forecasts for the outlook, really believe you've got a fast-growing market and there's room for growth in all the flavors of battery technology that are out there. And certainly, even when it comes to the evolution of the more nickel-rich chemistries, even we allow for a reduction in intensity of the use of cobalt going forward, but the bottlenecks are still sufficiently severe, and the sheer volume uptake of cobalt units through the growth of EV demand, that all of those factors still deliver a very, very attractive percentage CAGR going forward that more than offset that reduction in intensity that we could see ahead of us.
What is the supply picture look like when it's going to be met with growing demand, James? There's some benchmark and other analysts that say, look, we're just not going to be able to produce enough of the types of battery metals that we need when you look at the time it takes to build mines as well as to take the refineries.
Look, we're in broad agreement with that thesis. To start with cobalt, we've seen an extraordinary development in the price. It's almost a 250% increase since December 2020, as the price has moved from $15 a pound to almost $40 a pound. And really what we're seeing is this pull through of the demand drivers, not only recovery sort of post-COVID of traditional industrial uses in cobalt, but also a profound acceleration in EV demand and the real translation of that we're seeing in a way that's lasting and meaningful. And look, I would agree with you. I mean, you put that together with the supply side outlook. The supply is dominated by the DRC in cobalt, which is exactly why we're looking, why we're so attracted to the Idaho project that we have as a diversification and opportunity away from DRC mine supply. But the reality is that there are, challenges in the DRC. The mines that are there, the grades aren't what they used to be. There's expansions and restarts of certain mines that are contemplated, but we think those will be staged and gradual. And you put that together with a series of logistical constraints that we've seen recently in terms of supply chain and how cobalt needs to move out of that region into the wider world. And what you sort of see ahead of us is a very attractive picture from our perspective, where we would expect to see that market tightness persist for a good period going forward. I think on nickel, it's again a thematic that's dominated by EVs. Look, we're more directly involved in cobalt today than nickel, but we have nickel exposure through Brazil. And again, what we see there is the battery grade nickel demand is surging. You're seeing stocks deplete and supply response is sluggish. I think there's some key questions there, which is, there's been near-term disruption from Russia, how that plays out in the context of Russian units in the market and the role they have in satisfying future demand with the geopolitical overlay. And then key questions around Indonesia, for example, where there's a lot of nickel in the ground, has to come out through expensive and carbon-intensive routes. And the other question, as well as sort of the headline supply-demand tightness, will be, not all nickel units will be born equally. Some will be more carbon-intensive than others. And really, it's for OEMs to determine, with their ESG approach, which units they want to have in their supply chain and then what that means for prices going forward.
Some of the North American nickel juniors that are advancing nickel projects have flagged refinery capacity as something that could really hinder any type of development of mining in North America. Yeah, no, we certainly see one of the reasons we're attracted to refining is we do see it as a bottleneck. There is particularly outside of China. China has dominated refining for many, many years. And, what we're looking at in Brazil is exactly that, which is how do we provide an outlet for, junior miners or other players in the industry who've got their hands on raw nickel units, but need an outlet for processing, and doing that in a way with a partner that's credible and trusted and has the right technical and ESG credentials to really provide that full traceability and that reliable supply that they're going to need going forward. So very much part of our strategy, and we believe that a large part of the segment in the industry and in the investor community is very much focused on mining, where there will be some scarcity. But we think actually in these high demand growth environments, it's also not going to be straightforward bringing on refining capacity, given the technical skill that's involved and given what it actually takes to construct or bring online new refining capacity in a short space of time. James May, thanks for speaking with Kitco. Thanks a lot, Michael. Appreciate it. He's James May. He is CFO at Jervois Global. My name is Michael McRae, and you're watching Kitco Mining.